Hello, welcome back to the next of our ACCA P2 lecture recaps. This is a recap of the full course lectures that are available on our website shown below. Also on that website, don't forget you can download all of these mind maps as a PDF for free, so go there to get that and check it out. This lecture was continuing the group statement of financial position and adding in a couple of things. So the first thing that we talked about was post-acquisition profits. So post-acquisition profits, what are we talking about? We're talking about if we've acquired the subsidiary prior to the reporting date. So in the examples up to this point, we've acquired the subsidiary on the reporting date. But if we acquired the subsidiary prior to our reporting date, that means the subsidiary will have earned profit between the acquisition date and the reporting date. So the subsidiary will have earned profit between the acquisition date and the reporting date. And we need to include this. We'll include that in working 5. Remember, working 5 is our parent's accumulated profit plus the percentage of the subsidiary's post-acquisition profit. So that's where we include that post-acquisition profit of the subsidiary. Pre-acquisition profits, what do we do about those? Well, those are already included in the net assets at acquisition. So they're already included in working 2. We cancel those out then in working 3 when we calculate our goodwill. So the pre-acquisition profits are included in net assets at acquisition and they're cancelled out when we calculate our goodwill. So really we're only needing to worry about our post-acquisition profits. We looked at illustration 4. We did working 1, which was our group structure. Key things on working 1, check the percentage ownership and note the date so you get the date of acquisition correct. Working 2 is our equity table to calculate the net assets. Again, check the date of acquisition, check accumulated profit at the acquisition date, and then fill that into your working. Working 3 is our goodwill. Basically, we need to look at what assets have been purchased. We take that from our net assets at acquisition, which is in working 2. So we look at what assets we purchased, the net assets at acquisition. Well, we've calculated that. We calculated it in working 2. How much was paid? What was the consideration? And fill that into our standard working for goodwill. Working 4 is our non-controlling interest. We need to check the percentage in working 1. And then fill that into our working for non-controlling interest. Working 5 is our group accumulated profit. We're thinking about any post-acquisition profits. If we have post-acquisition profits, we'll have to get the parent's share, and that will go to working 5. And then the NCI share will be included in working 4. So just a note on the double entry involved here. Because you could ask, we're adding across all the rest of the assets and all the rest of the liabilities. So you could ask, why not cross-cast our accumulated profits? Well, it's because we need to share them out. We need to share them out between the non-controlling interest and the parent. So that's what we're doing in this scenario. How do we do it? The double entry is this. We're debiting the subsidiary's accumulated profits at the year end, so that removes them. So we debit the accumulated profit, that removes that from the subsidiary's accounts. So we're removing them from the subsidiary's accounts, and then we are crediting our non-controlling interest with their share. We are crediting the parent's share of pre-acquisition profits to goodwill in working 3, and we're crediting the parent's share of post-acquisition profits to working 5. So that's how the double entry occurs. We remove the subsidiary's accumulated profit by debiting the accumulated profit account. We then credit the NCI with their share. We then credit the parent's share of pre-acquisition profits, that's done in working 3. And we credit the parent's share of post-acquisition profits done in working 5. So as we said, debit subsidiary's accumulated profit to remove it. The credit entries will be to share it out. One last note just on the acquisition date. We need to be very careful with our acquisition date. This is the date that control has been obtained. Why is it important? Well, it's important because that's the date at which you calculate your goodwill. So it'll have a big effect on the goodwill calculation. Also, it'll be from that date on that you consolidate your profit. So the profits of the subsidiary will be included from that date. So it's important to get that date right. How do we determine when that occurs? Well, maybe a written agreement or a contract for the sale of shares in the subsidiary, something like that. Or it could be the date at which the parent starts directing policy, or the date at which the parent has a majority appointment to the board. And we looked at that in illustration 5. So that was lecture 4. Again, adding a few things to our group statement of financial position.